You're not hungry. You're not a killer trying to get every single ounce of revenue you can. And of course, the VC doesn't like that either because that means less revenue, less value. You want to find alignment. Let's talk about capital raising. So I've been working with a couple different founders over the last couple of weeks as we head into the end of December on their capital raise, what they need, what they should be thinking about, and really how to approach it in the new year. I wanted to highlight a few of these questions and give a little context, and hopefully it helps you. So, first question I got was, how do I engage with these investors, especially around the holidays? Well, fundamentally, I take the approach of however the investor first and foremost wants me to engage, whether it's on their LinkedIn, it says reach out, whether they're a partner at a venture capital firm and they have an email button, or they say submit your contact form to us, or whatever it might be. Maybe they have a whole form system that collects information and files and DocuSends, whatever it might be. I am always of the mindset I want to come to them. I will always lean in, do the extra effort, and make sure that if they've gone through the trouble of specifying how I should engage with them, I'm going to at least do that before I start getting fancy. I'm going to say, all right, they want a LinkedIn message, sent. If I don't hear from you, if I don't hear from you 1 day, 2 day, 3 days, a week later, maybe they'll get an email. Maybe if they're local, I'll bump into them at a networking event. Maybe I'll try and get a warm intro. Maybe I'll just follow up again. There's a bunch of different ways to approach it, but I try to treat it very individually because a big thing that founders overlook is it's not about volume. You can easily mass market and send emails to 1,000 VCs all at once, have all of them hate you, and that's kind of the end. You could also reach out to one, two, five, 10 people that are VCs or investors or high net worth individuals if you're going more the angel route. And these people could all convert. It's really not a numbers game as far as you're not trying to talk to 1,000. You're trying to talk to the right 1, 5, 10 that are really material and can, of course, drive that conversation forward and ultimately get you the capital. So, hopefully, in the context of how do I reach out, it gives you a little bit more to lean on. And remember, always do what they want first, because the worst case scenario is you don't do what they want, you somehow get in contact with them, and then they go, why didn't you do what I asked you to do? Can't you follow basic directions? It's a little bit of a dig, fair enough. I mean, you managed to talk to them, but you didn't do what you should have. And that's not very mentorable. That's not very coachable. That's not very collaborative. Again, especially if their ask was easy, like send me an email or fill out our form or whatever it might be. Next is a question on if VC is right for me. Now, this is, of course, a very individual question, founder to founder, company to company, situation to situation. Sometimes you don't have a VC friendly team. What does that mean? Maybe your founders don't show that well, meaning maybe they're not the most professional, meaning maybe they're more good at development and customer acquisition or growth or planning than they are like professional level investor ready. Maybe from that side, and I've worked with companies like this, they've elected to go the angel route, the friends and family route, the self funded route, because they don't want to be put through the slog of talking to VCs and dealing with everything that, of course, comes with that, good and bad. There are other founders that their only choice is venture capital because they've already raised their friends and family money, they've already exhausted all the angel investors that they possibly can, and now they're at a spot where I'm raising 5 mil, 10 million, 20 million, whatever it might be. Guess what? Unless you're dealing with some really, really, really rich people, you're going to have to talk to some venture capitalists, some family offices, some more institutional investors that can actually afford to write big checks like that because not everyone's going to dump their entire savings into your company. And these VCs, of course, have enough capital to take some risk and to do these things. Doesn't mean that automatically they're going to invest in you just because you're raising a ton of money. No. And in fact, of course, the more money you raise, the more the diligence is, or at least the more the diligence should be. You know, you've seen the news, you know that's not true, but we won't talk about that here. Next is how much equity should we give away? Now, again, my favorite two words, it depends. But generally speaking, we're talking in the 10 to 30% range, depending on your round. Of course, you're always going to want to sell less. They're always going to want to take more. So it's very much a dance of where can we meet in the middle and can we find some good synergy to, of course, just keep the conversation and keep the business moving. Because owning 100% or 95 versus 90% of something, It's not that much difference, especially if it goes to zero because you didn't get the funding that was 2 feet away from you, one handshake away, because it was 5% of a company that probably isn't worth the value that you're trying to ask for anyway, if you really, really had to justify it. So, this is an exercise in you want to kind of be in the band of acceptable, that 10%, 15%, at the high end towards like a series A, more of like the 25, 30 or more percent. Whereas earlier stages, idea stage, pre-seed, seed stage, you're dealing in that more 10 to 20% per round. But you also don't want to do a lot of these rounds because that's how you end up selling most of your company. Now you don't own a lot of it. Now you're not that motivated for all the work that needs to be done. And everybody loses because you're not hungry. You're not a killer trying to get every single ounce of revenue you can. And of course, the VC doesn't like that either because that means less revenue, less value. You want to find alignment. And there are deals that have imploded because previous VCs or investors took too much. They took so much equity that they de incentivized the founder. And now that company just kind of floats. It's got an unmotivated executive team of a mid level growth company that doesn't have the energy, the excitement, the appropriate amount of greed, shall we say, given they built the thing, to actually see it through to that 100 million, 500 million. Maybe it's a unicorn. Maybe it's the billion. Who knows? So as you look at these things, one, how much money are you raising? Two, what type of person are you? And do you actually want to take on venture capital discussions, venture capital due diligence, all the board meetings, all the negotiations, all the updates, all of the ongoing questions that come with having professional investors? It's not something that can't be learned, meaning it can be learned. Lots of people have, and lots of people will. Lots of people that know a lot less than you, I can assure you, and lots of people that think they know a lot more and they most assuredly don't. So it's not a question of like intimidation, it's a question of appropriateness for your company and willingness ultimately for you. The last piece that I want to touch on, just because I got asked it earlier today in a client meeting, was timing. It's December. There's a lot going on. No matter what religion, what this, what that you care about, there's a lot going on in this particular month, which means flights and travels and issues and canceled Zoom meetings and crazy weather and everything in between. Now is not the month to be a crazy aggressive with every single bit of outreach. It's the time to outreach. It's the time to engage. It's the time to set up meetings for the beginning of the next year because, let's be honest, very few people are going to meet with you on December 26th. They might, and maybe they'll meet with you between that, dead zone between the 25th and the 1st. Absolutely. But more than likely, they're not going to be writing these big checks and making huge decisions until they're either A, in the new year when they've kind of reset their income, or B, once they actually have time. Because, of course, especially if you're talking to a venture capital firm, it's not a 1 day due diligence. It's not a couple hour due diligence. And at a minimum, let's say they said yes on a Monday, it takes a little time to get that money wired over to you. It's very rarely just like an overnight instant thing. So even if they said yes on December 26th, you may not get that money till sometime in January or even after, depending on how efficient you are at processing all of the steps to actually receive the money. So what I told them is what I'm going to tell you. It's important to be very empathetic to the VC. It's not to say you have to, love them and write them a Christmas card, but it is to say, imagine you were them. Imagine you ran a 20, 30, $50 million fund. Would you be where you're at right now? Or would you probably be vacationing with family, taking some time off, doing X, Y, and Z? Again, we're kind of being a little human here, but sometimes that's what it takes. And sometimes that's all you need to have those conversations, do that outreach, and set next year up for a really big win. So that's all the questions that I had for today. Hopefully, this is helpful in giving you a little context on how you can approach this capital raising activity, especially end of year. And let's get set up for a really great 2024.